OptionChampion.com.
Today is Saturday, January 21st. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to the first episode of Tricks of the Trade in 2023. A quick programming note before we dive into today's content. Tricks of the Trade has been moved to the third Saturday of every month, following Expiration Friday in the regular monthly cycle for equity options. Well, earnings will soon be pouring in from the fourth quarter of 2022 for a handful of big-name stocks, and I put on a trade in one of them. Take a look. We're taking a look at an earnings trade that I put on in Meta, formerly known as Facebook. Meta is expected to report earnings on Wednesday, February 1st after the bell. And this is a walkthrough of the analysis that was done to select the strikes for my position. I pulled in the historical prices for all of 2022, and within each quarter of 2022, I summed together the net change in the stock price on a rolling 5-day basis. And within those results, I identified the largest 5-day change down and the largest 5-day change up. And on the graphic here, there is a Min and Max column. The Min column is the largest 5-day change down, and the Max column is the largest 5-day change up. And for each one, there's a period column for the number of days into the quarter for the change up and down. So for example, in the first quarter of 2022, the first row there on the graphic, on a 5-day basis, Meta lost as much as $98 per share 22 days into the quarter before reversing to the upside and gaining as much as $28 per share 49 days into the quarter. And these results tell me how much Meta stock is capable of moving in either direction, and in turn helps me establish a range that I can then use to select the strikes for my earnings trade. Now, when creating a range on a trade, and when I say range, I'm referring to the width of the spread or the distance between the two strikes on a two-legged position. I never want to go too wide on the range or too wide on the spread, because the wider the spread, the more the underlying stock price has to move in order for the trade to become profitable. When it's a long spread, the underlying stock price has to move outside of the spread in order to become profitable. The stock price has to rise above the higher end of the range or fall below the lower end of the range to become profitable. So I always want to keep my range or my spread as tight as possible, but not on the at-the-money strikes or so close to the at-the-money strikes that I'm paying too much for the spread and taking on too much risk. I want to have a tight spread that's far enough away from the at-the-money strikes that I'm paying less than the spread, and also creating a range that the stock is capable of trading outside of. So, all that being said, going back to the graphic here on the screen, I chose the smallest 5-day change down and smallest 5-day change up, that being $22.86 down and $22.96 up, and rounded those down to 20, and then split that 20 above and below the underlying price of the stock at the time of the trade. The stock was priced around $140 at the time of the trade, so splitting that 20 above and below 140 meant $10 above $140 and $10 below $140, and that gave me a call strike of $150 and a put strike of $130. And the difference between the two strikes is a $20 range. So with all of that, I bought a 130-150 strangle expiring in April, 91 days until expiration. And I went that far out because I wanted to have a little bit more time after the earnings release, just in the event that there are some more big moves in the stock price. The goal is for Meta to rise or fall beyond the range of the strangle before expiration. Scenario number 1 would be if Meta rises $20 per share to $160 per share. That would be above the $150 call strike. Scenario number 2 would be if Meta falls $20 per share to a price of $120. That would be below the $130 put strike. And either scenario will cover the range of the strangle. Now, it's not noted on the graphic here, but I paid $17 for the strangle, which is less than the $20 spread. The distance between the $150 call strike and $130 put strike is $20, and I paid less than that. I paid $17. So not a whole lot less, but still less than the spread. So that satisfies what I was saying earlier as far as wanting to pay less than the spread and still be within a range that the stock is capable of trading outside of. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.